Welcome back to Private Market Talks. I'm your host, Peter N. Tushik. Barings, a subsidiary of MassMutual, is a global asset management firm with approximately $442 billion of assets under management. David Mihalick has served in various roles at Barings and is currently co-head of global investments, responsible for the oversight of Barings' global investment platform, spanning public and private markets in fixed income, real assets, and capital solutions. Prior to entering the financial services industry, he served as an officer in the United States Air Force and worked in the telecommunications industry for 7 years. David holds a BS from the United States Air Force Academy, an MS from the University of Washington, and an MBA from Wake Forest University. During our conversation today, we discuss Barings' investment strategies, the impact of tariffs and other policies of the current administration, how middle market companies are managing under current economic conditions, and the impact of AI on human capital in private markets. As with all our episodes, you can get a full transcript of this episode and other helpful information at privatemarkettalks.com. And if you enjoyed this episode, drop us a note. We'd love to hear from you. And now, my conversation with David Mihalick, co-head of global investments at Barings. David, welcome to Private Market Talks.
Thank you very much for having me.
And thank you for your service.
Well, thank you. It was a great way to start my career. It seems at this point like it was a long, long time ago, but definitely a foundational part of who I am as a professional and helped shape the way you think about the world.
What did you take from being an officer in the Air Force that you've brought to your professional life?
The leadership things you learn at an early age, graduating, I went to, as you mentioned, undergrad at the Air Force Academy, so graduated and was commissioned as a second lieutenant. And, at 22 years old, you've got people working for you, dealing with real life problems, not just work problems. In the military, you get involved in all aspects of someone's life to ensure readiness. And so I think it forces you to mature pretty early on, think dynamically, learn how to work with people from different backgrounds. So it's a great way, just, not obviously not financial services, but just kind of being a professional, being flexible, being thoughtful in your approach and learning how to work with different people.
So for the benefit of our listeners, can you give us a snapshot of Barings investment strategies?
Sure. Barings is a $440 billion asset manager. We are 100% owned by MassMutual Life Insurance Company. You break down our AUM into big buckets. We've got public fixed income, which is about 215 billion of AUM. A bucket I would call private fixed income and capital solutions, which is about 137 billion of AUM. And then a real assets business that is about 70 billion of AUM. And that would include our real estate debt and equity businesses, as well as an infrastructure debt business. So that's sort of the pie, if you will, of everything that we do. As I mentioned, we're owned by MassMutual, so we're a private company owned by a mutual company. So, I think what that leads in terms of philosophy and how we think very long term. So we're not reporting quarterly earnings. MassMutual's been around for 170 years. That Mass is invested in. I always hesitate to say everything or 100%, but 99% of what we do, MassMutual is invested in as well, typically. So we have that alignment with our third-party clients, and they know that we're thinking very long-term when we're thinking about investing. So that at a high level sort of summarizes to me how I think about our platform.
And can you break that down a little bit? In fixed income, what are you doing?
Sure. So in our public fixed income business, we have, traditional investment grade corporate bonds. That's for a life insurance company, obviously our parent company. That's a big part of their portfolio. We've got a very big liquid high yield platform that would include loans and bonds in the US and Europe, as well as structured credit. We put our CLO platform, we put in our high yield and structured credit business, so under the public fixed income business. So those are the big buckets. We've also got an emerging market, sovereign and emerging market business that we manage within that. So that's the bulk of that franchise.
And the private strategy?
In our private business, we have traditional private placements. So you think about it, the way the markets have evolved, right? A lot of those things you mentioned on the public side, you can sort of get access to very similar risk on the private side. So we have a large private placement business, for example, which is very similar in terms of risk exposure to our investment grade corporate bond book. It's just you pick up an illiquidity premium in the private markets. Similarly, we've got a large direct lending business, so providing capital to middle market leverage buyouts. So the risk there is very much like our high yield loan and bond business, just in private form. So you get a bit of a spread premium in that market. We've also got an asset-backed finance business. I mentioned an infrastructure debt business, and then something we call capital solutions, which is a term that I think people use a lot. But I think anytime someone says that, you have to ask, what do you mean by that? It's a very generic term. So that business for us grew out of our distressed lending business back, 15, 20 years ago. And, as we really haven't, there's been sort of episodic default issues, but not really a large corporate default cycle over the last, really since the financial crisis. Again, there's been things that have happened in specific sectors, or you had COVID, of course, but not a traditional deep recession that involved, resulted in broad-based defaults. But that business evolved from focusing on sort of workouts in the financial crisis to really being a flexible source of capital. So think about potentially non-sponsored deals or anything that doesn't fit in a traditional bucket that we described earlier is something that team may look at. We have a small private equity business, think lower middle market private equity business that does co-investment alongside some sponsors as well as fund investing. And in terms of capabilities, we tend to call that capital solutions as well, which I think is an interesting area when you think about, the ability to provide continuation vehicle capital to sponsors and some of the things going on in private equity now. So capital solutions, it's a label we put that's pretty broad, but it really is those flexible situations where it doesn't fit neatly into one of the traditional buckets that someone might think about.
And just to round it out, the real asset component of your investment strategy would include what?
Yeah. So we have real estate equity capabilities globally. So we have a team in the US, a team in Europe, and a team in Asia Pac. The team in Asia Pac was a business we acquired a couple of years ago called Altus Property Partners, based in Sydney. So we're excited about that added capability. And then just a few months ago, we augmented our US equity capability with the acquisition of a firm called Artemis Property Partners. So, real estate in general is an asset class we're excited about and investing in. So that's our equity platform. We also have a large real estate debt platform. Obviously, MassMutual, as a life insurance company, has always had appetite for real estate debt. We've got a really nice growing third-party business there as well. We're seeing a lot of interest in real estate debt as an alternative to private credit. I'm sure we can get into some of those sort of market trends we're seeing. And then we've got an infrastructure debt platform. That's a business we've been in a little over 10 years. It was originally MassMutual acquired a portfolio out of a bank. We have a team, and we've now, over the last several years, been investing in that team and adding third-party AUM as well.
So when you look back over the last, say, 5 or 10 years, what has been the driver of growth for Barings?
I'd say the biggest organic growth we've seen was in our direct lending business. I mean, you've seen today there's been there's at least the last couple of years, a headline every day about, the private credit market and whatever it is, 1.7 trillion, and however people bucket it. That's a business we grew organically starting in 2012, 2013 timeframe. And so we've seen really nice momentum. That's 35 plus billion of AUM and close to 45 or 50 billion of commitments. Our core high yield franchise has grown as well very nicely over the last 10 years. And that's really been about evolving the product offering there from single sleeve strategies to more multi-asset strategies. I think we were early on in that. So recognizing that when you're looking at corporate credit risk in developed markets, it's very similar in terms of the US investing versus European investing, but there are nuances and technicals of the market that can create opportunities to get outsized return in one market or the other. So we had a big platform in each area, and we're able to bring those capabilities together in a global platform, and that was appealing to our clients over the years. And then more recently, I'd point to real estate as something where we've seen nice organic growth in our debt business, and then we've augmented our equity platform with a couple of acquisitions where we see, it's obviously a big river asset class. We had the disruption in the office market associated with COVID and the rate move, but long term, we think there's a lot of opportunity there. And so it was an area we wanted to invest in. Again, we've seen organic growth, but we knew to really position ourselves for where we wanted to be longer term. We needed to augment our capabilities with a couple of acquisitions we did. So we've seen growth there and really excited about the potential for that platform over the next 5 to 10 years. We've been in that business for decades.
Looking forward now over the next 5 to 10 years, where do you see the greatest opportunities for growth?
If I look across our platforms, again, I would expect what I would call our sort of core franchises, leverage finance franchises. So our high yield and structured credit teams and our private credit teams to continue to grow. So we feel good about those. They're scaled capabilities today, and we should continue to hopefully capture market share. So we're continuing to invest in those. Then beyond that, I look at our real estate platform, talked about that a bit earlier. Good size there, but I think we can get a lot bigger. And those acquisitions that I mentioned that we made, we're really excited about those. So we're in the process of integrating the more recent one. The Asia Pac deal was smaller, but it's been integrated at this point. And then they're looking at some organic build out opportunities outside of their core markets in Australia. So real estate overall, I'm excited about. As I mentioned, real estate debt, with some of the issues that have gone on with banks, we've seen a lot of interest, a lot of opportunities from an investment standpoint there, and a lot of interest from clients as a diversifier away from traditional corporate credit. So you get a similar risk premium in that market to what you might get on a private credit deal, but you're exposed to a different underlying risk. Similar story with infrastructure. So all of that real assets bucket that we talked about earlier, we've got a lot of exciting growth opportunities there. And then probably an emerging area, and you're hearing a lot about it in the last couple of years, is asset-backed finance. And so that's an area where we're spending a lot of time right now thinking about. I think about it like we've got all the ingredients in the cupboard, if you will, and that all the things that people talk about in ABF, we do. And we've spent a lot of time over the last year and over the next year or two thinking about how we organize, how we create product around that. There's some unique origination that you need to invest in associated with that. So that's a big focus area for us, but something that I think has really big long-term growth tailwinds. And again, we're not unique in that. You're seeing a lot of headlines around that. But like I said, we've got all the capabilities that you hear about in the market. They're at different sort of levels of readiness, if you will, today. But we're really focused on, making sure we have that platform right. I think it'll be a big growth driver for us over the next 5 to 10 years.
So, David, as a global platform, how are you thinking about allocation of capital geographically?
Yeah, I would say it varies by strategy. And I think that's a really good question for a strategy, right? Like we don't have that as a firm. But I would say on average, if you think about the US markets being, on average, traditionally the biggest, most liquid developed markets in the world, which is great for access to capital, but they tend to be a little more efficient. And so, as I mentioned earlier, like in our leverage finance business, when you can get exposure to comparable risk in a market that maybe is not as liquid or as deep, so Europe versus the US and the syndicated loan market, you tend to get a bit of a risk premium. And I would say similar when you go into Asia Pac as we're investing there, very similar risk, maybe not as big or as deep of a market, but you can get, a return premium because of that. And so I would say, if you look just sort of thematically how we think about things, having that global scaled capability, and if you take the US as sort of the baseline market, when you can find very similar risk outside the US market and either less efficient markets, again, this is painting a really, really broad brush, but on average,
Sure.
you can pick up a risk premium. So we would tend to look for those opportunities as differentiators in our clients' portfolios that give us that global mandate.
So, when you're looking at the US, how do you think about the economic headwinds facing the US in terms of the impact of tariffs and geopolitical considerations and conflicts, inflation, supply chain challenge, general economics, all of those things that we read in the headlines?
Yeah. So I'm co-head of investments at Barings with my colleague Martin Horn in London, and we've worked together for 15 years. And so let's go pre the current administration. And when we would have talks around relative value in the economy, whatever was going on in the US, Martin would say, you guys are a little too dour compared to what's happening in Europe. So, so having that perspective matters. Now you get into 2025, and of course we've got these acute headlines and a lot of uncertainty that's come in with whether it's over the last couple of years, rates, inflation, the resetting of the real estate market, now tariffs, impacts on trade, how all of that, and then headlines versus what's actually happening. I would say, like everyone else, I think when we get into these periods of uncertainty, my instinct, at least as a historical credit investor, is to focus on the fundamentals. And so, when we've got a large team of analysts across the platform, when you get into these periods of uncertainty, it's really important. It's too late to make a lot of adjustments to your portfolio, particularly in private markets. You sort of own what you own. So you need to be thinking about this kind of stuff early and often. And the example I'd give of that on our platform is our private credit team, as soon as the tariffs were announced, had a full, robust analysis of our entire portfolio, expected impact on tariffs. And the reason is because they started that work in January. And that's because part of the president's, campaign or platform was tariffs. Now, did we anticipate the way that he did it? The amplitude of some of the things that were announced? No, but we had done a ton of work heading into April in anticipation of some change in tariff policy. And so that sort of bottoms up approach, if you will, is just foundational to how we think about investing at Barings. And so, I in terms of your question around, the economic outlook, I mean, when we look at our portfolio, we still feel pretty good about how companies are performing, but recognize there's more stress in the system today than there was, 3 or 4 years ago. The combination of higher rates, potentially a little bit weaker economy, and driven by all the different policy changes. It's really a time to, like I said, buckle down, focus on fundamentals, make sure you have a theme to how you built the portfolio, and then just trust that the hard work you'll do through any volatility will deliver good returns for your investors.
In terms of looking at new investments, however, how do these factors factor into your underwriting strategy and also risk tolerances?
Yeah, well, I think it's funny. That's a risk tolerance, I think, is the right word to always keep in mind, right? Because history would tell you that when things look the worst is when the best returns are to be had, right? Now,
Sure.
you have to take measured risk. You have to be thoughtful. But, when you look at when times are bad, the deals that are getting done, particularly if you're on the credit side, right? Someone still wants to do that deal. Someone's probably writing a bigger equity check maybe than they would have before, and they're going to pay a bigger premium for the debt. It means they've got a lot of conviction on the deal. So the ability to partner with people you've been in business with for a long time through those uncertain periods, I think is a hallmark to how we think about being a solutions provider to our clients, right? Whether that's our investor clients or our sponsor clients we may be doing deals with. And that's where I mentioned earlier in the conversation, that alignment with MassMutual, right? We're ingrained in our DNA is not thinking about the next 6 months. I mean, you got to get through the next 6 months to live for the next 5 years, but we're thinking about that longer term model. So that to me is a foundational part of how Barings as an institution thinks about investing.
And how do you think about just general levels of debt?
It's the lifeblood of the economy, right? I mean, debt in general, right? Everyone that buys a house, or most people that buy a car, they're using some form of financing, and hopefully they're doing it responsibly. I think when you look at aggregate, there's headlines around a bit of stress with consumers and things like that, and we're watching that. We've got a big book of residential mortgage exposure, so we have insight into some of those things. When I look at corporates, I feel like, we've been in this higher rate environment for a number of years now. Again, you got to if you have a good company with a reasonable amount of leverage and a strong sponsor, that they can figure out a higher rate environment. And we've seen that in our portfolio. As rates rose, you saw interest coverage come down. Maybe there's some decisions made on capital expenditures or M&A because a little bit more had to go to service debt. But that's largely stabilized, and we've been in a relatively stable rate environment for a period of time now. And back to what I said earlier, so the deals that you're seeing get done in this rate environment, in this economic period of uncertainty, are generally good deals. And so, we feel pretty good about the opportunities that we're seeing in the market, and feel like debt in general is at a reasonable level in most deals. When you get into bigger picture macro discussions around the deficit and sort of national issues, that's probably a different conversation. And that has an impact on rates over time and things like that. But when we look at sort of the investing environment that we're operating in today, we feel reasonably good about it.
Yeah. So to your point, David, debt is the lifeblood of our economy and has been particularly for private equity. But there is some concern that private equity has lost steam. And so, how do you think about the state of private equity as it impacts your strategy for growth and direct lending?
That pressure to return capital for private equity sponsors is there. I think you're going to see, we have seen that increase, and just anecdotally through dialogue with some of our partners, and I think you'll continue to see it increase. I think the market for secondary opportunities is going to continue to grow as a result of that. The benefit we've seen in terms of having the big book of business we have and the partnerships we have with sponsors from an origination standpoint has really fueled our business the last few years in terms of add-on activity. You're maybe seeing a little bit less of that more recently, but still pretty robust in a diverse portfolio. But offsetting that, you have more corporate buyers coming into the market, strategic buyers versus financial buyers. The headlines are real, but again, I think for good companies, there's an option. It's whether the the seller likes the level or not. But a lot of them, again, have spent a lot of 3 or 4 years doing add-on acquisitions, working on cost efficiency in the business, and so if they own an otherwise good business, even though they may have bought it for 15 and it's only worth 12 today, the things they've done to do bolt-on acquisitions and improve operationally still can generate a good return. And if they think there's a longer term story there, the availability of capital to do continuation vehicles and things like that. So it's taking longer to achieve the returns. There's more pressure from LPs to get dollars back. They've got to execute on that to get to that next round of fundraising, to your point. But good sponsors with good companies will figure out a way to generate good returns, and we want to be partners with those types of sponsors.
So, one of the things you talked about is that you have a fairly extensive and substantial portfolio of middle market companies. And you touched upon a little bit of their resiliency in the current economic environment. I'd like to drill down in that a little bit more and get a sense of, and this goes to your comment earlier, which is what are you hearing versus what is actually happening? And so I'm kind of curious as to how you see these companies navigating the current economic environment.
Yeah, I'd say if I think back, and I'll paint the current, there's sort of the current administration and policy, and then there's, to me, what's happened sort of post-COVID with rates and inflation, right? Which is, they're both interesting stories. And so, the rate increase was, I think we got a lot of questions around, could companies adjust? And we saw companies adjust. We would underwrite, say, in the lower rate environment, 3 times interest coverage, maybe, 2 point something coverage after CapEx, capital structures that had flexibility to deal with higher rates. Now, as I mentioned earlier, as rates increased, that 3 times went to 2 times, but still the ability to service debt and make capital expenditures to invest in the business. Now, that higher rate, though, impacted valuations as well. So back to the ability to exit. So, we've definitely sort of, I think, in our portfolio weathered that, and where we've seen stress, it was around companies that had that and something else happening. So, and they had an operational issue, and they had, some other variable that then, it sort of maybe was a tripping point for them.
And tariffs hit.
And now, more recently, and tariffs, right? And so they've sort of done what they can to pass prices through. They've done what they can to run their businesses efficiently as they can. And now they're dealing with tariffs.
Yeah, but I guess I'm curious, are you finding that your middle market borrowers are able to pass on these cost increases?
They have some ability, right? They have the ability to sort of manage their costs effectively. And if it's a critical business service or software solution for a company, or they're making a part for a bigger company that's critical to what they're doing, they have some ability. They can't get egregious, but people all understand. And if you're a critical vendor, you're able to do some of that. Now, there are limits to that, right? But we definitely saw companies do that, but there are limits to it. And then you put tariffs on top of it. Now, the tariff issue, that's one of the benefits to me of, talk about the benefits of investing in middle market companies in general. They tend to be more domestically focused. So not, again, on average, there are some that import, all of their, costs, and those are challenged. But when you go back to services businesses, software businesses, light manufacturing, that imported piece of the costs can be on the lower end compared to a larger international company. So They're a little bit more insulated on average than maybe bigger companies from the tariffs. They're not immune to the sort of second order effects of, the impact on the economy, but we've certainly seen that. And then the other thing about middle market companies, for sponsors to exit, there's a lot more options to exit a $30 million EBITDA business than a 300 million EBITDA business, right? Like you just can be a lot more nimble in terms of what you do with it. And so I think, the middle market relative to larger cap private equity or being a lender to those types of companies, I think there's a lot more flexibility in what the sponsors can do with those companies.
It's been reported by some of the credit agencies that there has been across private credit a deterioration of interest coverage ratio and net profits among some businesses, broadly speaking. I'm curious from your perspective, what you're seeing in terms of default rates in your portfolio based relative to historical and what you're anticipating going forward.
I would say today it's still very manageable. And where we've seen issues, it's not as much rates, it's rates and something else happening. And if rates were still at zero, those something else's may have been sort of more manageable, but cash flow is a bit tighter. There's some challenge in the business, and there's just not as much financial flexibility to deal with it as the sponsor thought when they, underwrote it in a zero rate environment. So, like
certainly a zero rate environment is a very forgiving environment.
Yes, very forgiving. Still more, it's one-offs versus a broad-based issue. Now, as I mentioned, I think if, we've seen sort of interest coverage come from 3 down to 2 and sort of stabilize there, if you get another uptick in rates, that would be a concern and a challenge. So if, inflation and rates continue higher, most people are calling for rate cuts this year. I'm not in the business of forecasting rates, whether it's the consumer, corporates. I'm not sure that rates can go a whole lot higher before you have probably real challenges in the economy.
What kind of questions are you getting from your LPs?
Certainly now it's around tariffs, right? And that's where, again, we started answering that question in January. Thankfully, like to the credit of our team, it wasn't a directive of David Mihalick to go do that. That's just how our team's wired. It's like, okay, new year, what are the risks we're facing this year? Let's start looking at them. So that's probably the top question. People love to talk about where's the 10-year going? How many times is the Fed going to cut? We have tended to say, look, if we had that figured out, we'd probably be doing something different for a living. We answer that question by going back to saying, okay, we've underwritten these portfolios for a range of possibilities. We're partners with these sponsors. We've been with them for many, we would partner through any stress in the portfolio. But we always get asked about the health of the portfolio. So tariffs, what's going on with rates in the economy, and then what are you seeing in the specific portfolio are probably the 3 thematic things that I can think of that we talk about a lot. And then for more strategic conversations, it then becomes like, what are other things I can invest in that achieve the same objective, but diversify my underlying risk? And then that's back to things like infrastructure, real estate, sort of other, our cap solutions business. When people say if there's stress, maybe I'll lean into, that's to me, a sophisticated investor would say that's the time to increase my risk tolerance a bit, not the time to get super conservative. And maybe I should look at your alternative strategies because it could be a great time to deploy into some unique situations and drive outsized returns.
There was a period of time where distressed funds were raising significant portions of capital, expecting a downturn, which never quite materialized.
And you saw a lot. You've seen a lot of the the larger cap stressed issues and all the issues with documentation and how creditors have sort of turned against each other and all that kind of stuff. And I in my former world and our liquid part of our business, we sort of involved in some of those types of situations. And that's one of the advantages people point to in the middle market, right? That even if you have a club group of lenders, you don't have, everyone's aligned. Again, you've still got your equity and we're debt and your fiduciaries, and you got to, look out for your investors first and foremost. But for shorter term things, you can have a much more solutions oriented approach. If the company's broken and the cap structure doesn't work, then you have to ultimately protect your investors first and foremost. But if you've got a 6 or 12 month liquidity crunch that you can work together to see the other side of, then you can be flexible in the capital structure. You may pick some interest. You may, you do things to help, you do that in conjunction with maybe the sponsor putting in more equity, things like that. So you work together to achieve the optimal outcome for the enterprise and for both of your respective investors.
And you presumably in your deals hold all or a very significant portion of the debt. And that
Yeah,
is a
and
very, very different dynamic than in a large cap, almost syndication style
yeah,
private
and,
credit.
and those, those syndicated deals, the challenge you run into is, you could have $1 billion deal and there's 20 or 30 million of it that gets traded and takes the mark down 20 points, right? Because there's no marginal buyer and it gaps down. Doesn't mean that's fair value. I mean, I guess it's fair on that trade, but it doesn't mean you can't underwrite to something that, hey, it's worth a lot more than where that's trading. And that's what our liquid team does every day. It looks for opportunities in those types of situations. But yeah, in the private space and in Europe, in most cases, we're the sole lender or one of two. In the US, it's a mix of club deals, sole lender deals, just depending on the size of it. But it's usually a bank group that's been, that are all sort of have experience with the sponsor. And again, I would emphasize we're still looking out for our investors first and foremost, right? Like it is, there's sort of that collegial nature. But if there's truly a stress situation and the fundamentals of the businesses have changed in a way that was not anticipated at underwrite, sponsors, I think, understand that you got to look out for your investors first and foremost. And like I said, when it's that sort of temporary thing, you can work in partnership and you get through that together.
So, David, one of the mega trends in the industry is developing products and the means to access the private wealth channel. What is your strategy?
Yeah, I think we are definitely looking at it, as you say, that's, the interest in retail wealth channel to getting exposure to privates is there. And we have the manufacturing capability, if you will. And so we're looking to bring that into other, we're mostly in the institutional insurance channels. We certainly want to grow in the wealth channel. We announced a partnership with Invesco recently, where we'll be developing products together, multi-asset credit products, to distribute through their network.
How will retail investors evaluate managers? They're going to be relying upon the advice of financial advisors who may not fully understand the private markets and may not have the ability to effectively vet asset managers. That may lead them to default to the largest asset managers. And wouldn't that lead to a potential convergence of returns?
Yeah, you see that in the
Right?
BDC space already, right? And
Yeah.
we within our BDC sort of we track this, right, which is overlap in portfolios. And you look at like the biggest scaled ones, and there's like whatever the number is, 50% overlap. They're all
Right.
now offsetting that, right, is those guys are able to put the money to work. Because the other issue, right, for the smaller managers is, okay, I give you my money because I think you're unique, and if they raise a lot of money, then they can't put it to work in the same type of deals that
Right.
actually drove you to invest
Or
with them.
Yeah, and I actually think that the core issue becomes when you're evaluating managers, how do you distinguish among managers when it has been a momentum market?
Well, and the
Mm.
issue is you have that exact same dynamic, which I live with forever in liquid markets, right? Like when spreads are super
Totally.
tight and everything's great, you can't outperform. You outperform when you go through some sort of spread widening event, right? And either your portfolio performs, and what we would tend to find is our portfolios frequently would underperform on the downside because we tended to have a little more risk in it, but the active portfolio management during that time when you came out of it, that's where you sort of could buy cheap mispriced assets, right? And so
Right.
and now the issue in the private markets is you don't have that daily feedback. You don't have that opportunity to reposition, right? You live with what you've got, and it takes time. Like, and back to the partnership approach of, you're going to work with a sponsor up into a point. And so it could take several years of sort of they put in an equity, like you maybe pick a little interest, whatever. But you don't know until ultimately it goes bad. And the problem is if you wait too long, when it goes bad, it can go really bad. So,
Absolutely. And
yeah,
then you've got a whole issue of owning it and running it. And now you become a PE have a PE portfolio of troubled credits, which
yeah.
are incredibly time consuming. No, forget about
And
capital.
and that's back
Uh,
to small managers tend to not have the professionals to deal with that, right?
Completely.
So they would tend to maybe do a second, they just got to get out of it.
So, David, assuming the private credit industry successfully taps into the private wealth channel, are you at all concerned about the ability of the industry to effectively deploy this additional capital? Or do you think they'll see a race to the bottom in terms of structure and pricing?
So origination is key, right? And everybody would say they have proprietary or unique origination, and we would say that, but we need to continue as we grow to invest in that and grow that. Partnership with sponsors is key. So I'd say this: you see two things to me. You see spread compression for the good deals, right? Because everyone wants those.
Yep.
And then you see a deterioration in credit quality because the bad deals are still getting done. Someone's doing
Completely.
them. And so, they come with more spread premium, and they may have a higher yielding portfolio out of the gates, but it's probably a riskier portfolio that's not going to fare well when we get to economic stress. Like this is a hard business, right? It's the type of business that sounds good in headlines. It sounds simple, right? You give me money, I achieve illiquidity premium, I put your money to work and give it back to you, right? That's the headline, but doing it is hard. That's where, again, having scale, having the institutional approach that we have, we think we've got the right toolkit to be able to deliver it.
Well, thanks, David. I just have two final questions
All
for
right.
you. One is an employee at Barings, and it could be any one of the functions of analyst, underwriting, origination, portfolio manager, investor relations, risk management, compliance, legal, pick one. Which function will be replaced by AI first?
Oh, me, the talking head. I don't.
Yeah.
Oh man, you had to know I'm not going to answer that question. It's a great question. It's certainly, you know what? There was my miss on the whole interview when you asked what are the topics we get asked about most. I can't believe I didn't mention AI. So I'll go back and we'll edit that out maybe. But certainly AI is evolving and incredibly interesting. We had our CEO was traveling, doing some client meetings, and he came back last week, and one of the clients mentioned they have an AI bot that is in their investment committee now. And so it's not voting yet, but they intend to train it to the point where it's a voting member of the investment committee. That's interesting, right? I mean, we're of course looking at like RFPs and mundane tasks and how can we use AI to do it. But so that, in the other example, not to maybe I'll say your job, because
Maybe.
there's a tool that we've seen and used, and you've probably seen this, where you can take an annual report from a company and say you upload it and it creates a podcast, and it sounds like two people talking, and says, hey Bob, how are you, how was the drive in today, and like, oh, let's talk about the Mass Mutual annual report, and like it's a real podcast and it sounds super credible. But if everyone does that, they'll all have the same podcast. So I don't know how interesting that will be over time. So I know I wasn't going to answer that question. So that's my ramble about AI.
So, final question, given the impact that AI could have in the various areas, without identifying which one it would be first, what advice would you give to young professionals, either in your organization or elsewhere, looking to have a long-term career in this industry?
Yeah, be part of it, right? Like embrace it. And that's like, if you can see my whiteboard, literally on the bottom of it says AI intern project. So one of the things
There
we're
you
talking
go.
about with AI is I'm 52 years old. I can understand, I think, where it's going, but it's like the kids being digital natives, right? This generation, at some point, they'll be AI natives, right? So don't be so proud as a leader or someone with experience that you can't embrace young people that come into your organization and have no idea what you do, and say, how would you solve this problem? And so that's literally written on my whiteboard over there, is how do we get our interns plugged into AI? And so people have to embrace it. I mean, I believe and you've probably heard this analogy before, right? When Excel came out, people thought like you don't need accountants anymore. There's more accountants than ever, right? Like, Excel works, it does the math. Now, what do you do with it? And I think AI probably goes somewhere around that, right? Like it can put together the underwriting memo. You can upload all the information you have and say, give me 15 pages of why I should do this investment or not. but then someone has to decide to do the investment. I'm sure people will have AI
Maybe,
solutions.
maybe not, because you have the AI agent on the investment committee. I don't
Maybe
know.
not, maybe not, but then someone, I guess, has to train it over time, right?
Right.
So, and maybe we all just work 25 hours a week and life gets easier. Who knows where it will go.
That
So,
would be a beautiful thing.
yeah, but to a young person, certainly you have to, I mean, frankly, at any age, right? Even like, I think anyone with a sense of what's happening, even if you're later in your career, you need to embrace it, because it's not just changing your professional life, it's changing your personal life. If you have kids, it's changing their lives. So I think it's, you have to embrace it and be a part of it, and think about how it can be done responsibly.
Well, David, this has been a great conversation, and I very much appreciate you being on Private Market Talks.
I've enjoyed it. Thank you for the time.
And thank you, listeners, to listening to this episode of Private Market Talks.